What is going on, Future Focus team? Back at it with another video. If this is your first time to the channel, thank you, welcome. If not, welcome back. The purpose of this channel is to educate and entertain you, but the ultimate goal of this channel is to make you just a little bit smarter today in order for all of you to have a better tomorrow. And with all that said, we were talking today, and we were talking about, crash. They happen all the time. There's imminent. It's imminent that it's going to happen. And a lot of people have never experienced that. We talked about it face to face about how if this were to happen today, a lot of these investors who've seen nothing but the stock market go up, how would they react? I feel like a lot of them would be crushed. And it's not just how they say the Robin Hood traders from March or not like that. Like the stock market has been in a bull market since 2010. 10 years of prosperity. There's been some corrections every so often, but overall, it's been a bull market going up. So what I came up with here was, how to navigate through it. But before we even get into navigating through it, let's talk about what it is. What is a stock market correction? Because there's different ways to define it. So a correction is when the market gradually falls 10% from its 52-week high, and the main word there is correction. Gradually. It falls gradually. So over, it could be a few months, a few weeks. It's a gradual decline. It could be 4% down one day, 3% up the next day, 2% up one day. So it's gradual. A crash is a sudden and very sharp drop in stock prices, often in a single day or over a week period of time. And a bear market is a long sustained decline in the stock market once losses surpass 20% from the most recent high. So what I added here was some pictures that go through and kind of defined it. So this one goes all the way to 1870. And as you can see, like it's happened a few times. Right here, what you see from 2000 to 2010, we'll cover a little bit later, but that was like a dead decade because, as you can see, the market was down the whole time. So if you were here investing in the stock market bubble, the dot-com bubble as they call it, you were loving life, especially if you started investing like down here, all the way up, you were loving life. But imagine the people that came here, like that bull rush. And that's what I would say has been happening since March, like this whole era right here. And as you can see, it dropped, and these people didn't see their money again or gains for another 10 years. Some of them didn't see it at all because, they got scared and they sold out here, sold out here, sold out here. And as you go through, you see the next crash, the housing market crash. Some people lost even more. And people had to pull out here in this time frame. They had to pull out because of, the housing market was like really bad. So people were their houses were turning upside down. Him and I were just watching a documentary on it while I was working on this. Specifically about that, but people had no choice but to pull their money out of the market. It wasn't really that they were scared, is that a lot of people lost their jobs, kind of what you see going on in the economy right now, and it's kind of being masked by the stock market. So all right, so history. On average, the stock market has several corrections a year. Between 1983 and 2011, more than half of all quarters had corrections. That averages out to 2.27 per year. Fewer than 20% of all quarters experienced a bear market, averaging out to 0.72 times per year. Stock corrections are more frequent than crashes because they occur when the economy is still in the expansion phase. But you may be wondering why the market would correct even if the economic data is upbeat. This is because the stock market is a leading economic indicator, and he kind of disagrees with that, but he could say his piece later. And investors look at the future expected earnings to forecast corporate profits. They buy or sell stocks based on these projections, and sometimes investors become too optimistic, as happened in the dot-com bubble, and creating a rally that exceeds current economic performance. That's when the market gets overextended, and once that happens, any bit of doubtful news causes a correction. But that's what's different about right now. There's doubtful news every single week, especially like even this week. Him and I were watching the market, and we saw that jobless claims it was Thursday night. We were watching and we saw jobless claims were, they went over 1 million once again. and the market was down. And I told them, watch, they're all going to be green in the morning. And the very next morning when I saw them, I told them all green. They were all green again. So what's happening in the market and what's happening in real life, they're like in two different parallel universes. They're like not connected at all. All right, so let me minimize. So this is just a picture of what, you know, the dot-com bubble. As you can see down here is the years. And I just put this on here because even in before the double dip, because it dipped again, it took 4 years for it to recover to the same levels. When you see these charts like this, a good thing to look at is the volume. So the amount of volume that's going on during this time. Because when you see these days where there's a lot of red, like that means there was a lot more selling during those days. But you can see like that's the volatility index was probably really high in these days because you can see the red, and you know, you can see what the sentiment was during this time frame. Sometimes we just talk about the S&P 500, but I wanted to you know, add the Dow Jones in here as well. So these are some of the worst crashes in history to date. As you can see, 1930, again, same thing, man. If you were up here before the Great Recession, the Depression, if you were investing right before the Depression, you wouldn't have made your money back again until like the 50s. Again, when it dropped down here, you wouldn't have made your money back until, you know, 1995. But I'd like to take a moment and look at, while we're looking at this one right here, just know, like, if let's say this is for anybody, so there might be people looking at this video right now, and they may, if this were to happen today and the market were to drop just like this today, you may have bought here, you may have just started buying today, and tomorrow the market crashes. So if you're here, just know, like, it's not the end. It doesn't mean you have to sell. It doesn't mean, you know, the worst is over for you, because eventually the stock market goes back to its norm, you know. So as it drops, if you were to dollar cost average over here, you would be bringing your cost basis down. And so you wouldn't have to wait for the market to get all the way here to break even. You would have to wait, you know, if the market got back here and you kept buying, your time frame to recover from that crash would be greatly reduced if you were just to dollar cost average throughout this whole process. And then if you did it enough, depending on the duration of the actual crash or, you know, correction, you may even end up making money on the way back up, depending on, you know, how much you've invested. But the worst thing you can do is get scared. And I'm gonna go through a few different things to do as we go through here. All right, so I wanted to add this one because it just shows, you know, a depiction of how long it actually took to correct here. So even the unlucky people who invested 1,000 in the S&P 500 right before the stock market crash made their money back within a few years if they continued to add 1,000 to the market every year. So that's the dollar cost averaging I'm talking about. So in the Great Recession, you would have made your money back in 2 years, the dot-com bubble 5 years, 1970s 3 years, and the Great Depression in 7 years, you would have made your money back. I wanted to add this slide here because it shows all of the major crashes, not including the one that, it's even in here too, the coronavirus one. That's good. So it just shows, like, if you look down here, this is the amount of years that it took for it to recover. And you look on the right, 0 is the baseline. So they all got placed equally on 0, and it shows their declines. So if you can see in 1929, you know, it had the most dramatic decline of 79%. But as you can see, it just this was a great depiction of putting them all side by side together. So you can see the volatility in here, and you can see how long it took for each one of these different ones to recover throughout time. So why hasn't it happened yet? And I have a few reasons personally. This is my personal opinion of a few reasons why I feel it hasn't crashed yet, and it's been going straight up since March. The first one is the Fed. I personally feel that the Fed is putting a lot more liquidity into the market than they lead on. In February, they came out and they said, you know, this is before the market really crashed, but in February they came out and they said they were going to put seven, what was it, $27 billion into the stock market, I believe. And that was going to be like their limit. Oh, no, $720 billion. That's what they were going to flood the market with, buy bonds. Like that was their limit. And then in a few weeks later, they came out and said they're going to do unlimited funds. And then, you know, March 23rd came and it was like out of nowhere, hey, the market started recovering little by little. So I believe the Fed has been putting a lot of money, more money than they're leading on into the markets to make them liquid. Reason for that, for me to believe that is, you know, some of these nights we'll be watching it. And I say night because right now we're in Australia. So it's the time difference. The market's open here at night. So sometimes I'll watch it and it'll be down a lot pre-market, or even during the day, it'll drop a lot. But then you'll look at it and just the amount that it'll increase throughout the day is just is insane. A lot of people don't realize to move an index or to move even an individual stock, 0.1%, it takes a lot of money to do that. It's not just these Robinhood investors or you know, a hedge fund that can do it by themselves. Like there's liquidity coming from somewhere. So the Fed was my first reason I feel it hasn't happened yet. The second one was I discussed a little bit, and it's a forward indicator. So right now, you know, I feel that another reason for it is that since you hear all this news about vaccines and, you know, these companies getting billion-dollar deals like Pfizer to produce this virus, and then you have Russia coming out saying they're already going to produce one, and Putin saying he gave it to his daughter. Like all these little things that happen every week are giving people the indication that, you know, 6 months from now, we're going to be better than we are now. So people are less scared to put their money in the market as the economy starts to reopen. And is it really going to happen? If you're really paying attention to what's going on in the world right now, it's kind of hard to see that because, like we said, the unemployment numbers just went over 1 million again. The Jobless Claims Act, those went over 1 million again. So like it's looking at everything that's going on, it's kind of hard to see that, but that's another reason I feel it hasn't happened yet. And the third one is that I feel like it kind of has, and that's because the indices like the S&P 500, for example, it's cap weighted. So the biggest companies in there, the FANG stocks, like they've all been going up since this all happened. And because their weighting is so high on the S&P 500 and some of the other indices as well, the market has no choice but to go up because they own so much percentage of that indice. So there's a lot of sectors in the market that are not up. You have still companies out there like the resorts, the cruise lines, the airlines, like they have not recovered. Carnival Cruise Lines is down like 72% year to date, and it hasn't recovered yet. So, you know, it kind of has happened already. I added this one in here just to show as of, you know, in 2020, this is the stocks that are up 50% or more in the S&P 500, 25 to 50%, stocks that are up 10 to 25%. And then you start, once you start here, stocks down less than 10%, 79. Stocks down 10 to 25%, 92. Stocks that are down 25 to 50% in the S&P 500, 102 stocks. And stocks down 50% or worse are 26. So I don't think a lot of people see that, especially because, like I said, these 18 stocks right here are making up the majority of that index, and that's what's moving that index up every single day. Because every day these stocks are up, you know. So just keep that in mind. So this is the meat and potatoes of this presentation. You know, why are we talking about this? What is it that we can do? And I just came up with a list of a few different things to consider and a few different things to help you out, you know, even if it were to happen tomorrow when the market opens. First of all, ignore the noise. Sometimes the best action is no action. So, you know, sometimes the best thing you could do is not do anything at all and just be patient and wait. see how it really plays out. Uh, Tesla is one that you gotta know your stocks that you have in your portfolio. So like Tesla, I know that Tesla moves in like 21-day increments. I know that it'll go up for like 21 days and then it'll have a consolidation of like 21 days and then it'll be going down for 21 days. So, you have to know the stocks that are inside your portfolio and how they act, um, and how you're going to behave when the market does happen to crash. Second is be tactical and sell or hedge. So sell, but just know that you can sell for a loss, and I'll get into that in one of the next ones. Or you can hedge. So if you have stocks and you don't want to sell them, but you know that they're going to go down because they're up so high. So if you own these FANG stocks, there's things you can do. So you can buy puts that'll hedge yourself against those stocks. So if your stock doesn't drop, you're good. But if it were to drop, you would still make profit because you bought options that hedged you against, you're covered either way of what happens. Tread lightly when bargain hunting. Just because you think it's a great deal, if you're a little patient, you might be able to find it at a greater deal. It's called "Don't catch a falling knife." So it's like, have you heard that phrase before, Jesus? Don't catch a falling knife.
No, I never have, sir. Now with regards to market.
So don't catch a falling knife is probably the same place you've heard it before, the same context that you heard it before and whatever you heard it in. It's like a stock is dropping and you feel like you're going to get it at a great price, but like that metaphorical knife, when you go to grab it, is going to keep going down and you're going to get cut on the way down. You know what I mean? So you're going to hurt yourself by thinking you're getting a great deal. So the way you don't get hurt is, again, you dollar cost average down, or you average yourself down. Or if you already know, like, it's already reached your fair value price, then you're good. But just know you got to reassess every so often because things could have changed with that company. So you may have to reassess every so often if that fair value is still significant, is the same meaning it had the last time you assessed it. So just be careful whenever you think you got something on bargain, because it may not be a bargain. A lot of people thought they were getting hertz at a bargain and they didn't. So you just got to be very careful. Tax loss harvesting. So all this is like you can sell and you have $3,000 every year that you can write off as a loss. So you can put that in your taxes and they'll take it away from your earned income taxes. There's a few guidelines that coincide with that, so do your research with that. But tax loss harvesting is another way you can sell for a loss. Like if you only have a little bit of capital on the side and you see another opportunity that you know for a fact is great and you want some more capital, you can pull it and lose money in one of these stocks, and you could get some of that money back if it's less than $3,000. If it's more than $3,000, you can carry that over to future years. So if let's say you did $5,000 loss this year, you can carry $2,000 into next year and put it in those as the taxes loss. So that's another way to handle it. Reevaluate your own risk tolerance and your own asset allocation. So see where everything's at. This is a good way to prepare yourself for any future crash that may happen, because you start looking at what it is you have and how much it's suffered. And maybe your whole portfolio dropped 80%. Maybe next time you'll be more diversified. That you may have thought that you were really diversified, and you may just have to diversify just a little bit more, and find things that are non-correlated. So I know you like ETFs. You could get like 4 ETFs, and that could be your whole portfolio. And it could be like a bond ETF. It could be a stock ETF, a dividend ETF, a gold ETF, something that they're not correlated to each other. So when one is going up, that means the other one's going down. So that's another thing you can do. Reevaluate the percentage you pay for financial advice. And this goes kind of with what you asked me about mutual funds before. It may not seem like a lot, that 1%, 2%, 5% that you're paying your mutual fund manager or anybody who's managing your money. But whenever the market crashes, like that 50% loss, once that turns into a 52% loss because you're also paying somebody else, then you'll really feel it. And you'll start realizing that it really adds up over the years when you're losing 1% of everything you make every single year. If you do your research and you do things on your own, now that 1%, you can double that next year because you invested it instead of just gave it to somebody else to do the work for you. Defer major purchases. So if you had, you were going to buy a car, any depreciating asset, to be honest. I know some people down south, they buy guns. If you had like a big purchase, and big is different for everybody. So, somebody could think they're going to buy a 50-inch screen TV. That may be a big purchase for them. A cell phone may be a big purchase for somebody else. You can defer those later on because that capital may serve you better to invest it during a downturn because that money is going to double. And ultimately, you want, and this is the richest man in Babylon, like they talk about that. You want your money to go out there and make you more money. So you do that by buying assets and not liabilities. Robert Kiyosaki is big on that. An asset is something that puts money in your pocket. A liability is something that pulls money out of your pocket. So defer any major purchases and do them at a later time once the market is better, because that money will serve you better invested. Learn bear market history. Go back and see throughout time what has happened during what has been the best strategies for every bear market. And you'll see that there's similarities and there's differences, and you could try to compare it to what's going on right now. But history is great because it doesn't repeat itself, but it kind of follows the same trajectory. So lastly, know your own portfolio, and you'll be better suited to know when to buy, when to sell, and when to hold. Y'all have any questions? You got any questions? Jesus.
So you say look at history. I think that's a good indicator. What rattles my nerves is how short this correction is compared to other times in history. So I'm a little skeptical if we're out the bear market or if we're just getting started. Secondly, all the pros, they look at the debt market. That swallows the stock market. Your corporate bonds, treasuries, interest rates dictates all. When the Fed tried to move interest rates 0.25%, everything crashed, including Amazon, Apple, all of them. So interest rates, those are real, in my opinion, are the real economic indicators. The stock market being an economic indicator, possibly. I don't think it's a good one though. When you look at 1929, it goes like a zigzag. So when it went up, technically it's supposed to show a pattern of the market going up, but instead it just went like a zigzag down. So I think the interest rates the Federal Reserves comes up with are ultimately the best indicator for what's going to happen. I think the big question is, what other time in history have interest rates been so low for so long?
All right, so what I'll leave you with is that the stock market always resorts back to its mean. So the stock market always goes back to fair value. And that's what correction is. That's why it's called a correction, because it's correcting the values that are out there currently when things get hyperinflated, superinflated, whatever terminology you want to use. But the market always corrects it back down to the mean. And there's a saying, the stock market takes the stairs on the way up, but it takes the elevator on the way down. And all that is just a picture, just like the market will just gradually go up, but when it goes down fast. And that's a big reason I made this video, because I see a lot of things out there getting super inflated. And you know, I'm not the one that's like, you know, I watch these guys, I hope they get burned, I hope they get burned, these guys are stupid. I don't think like that at all. Like, I want to protect people from getting burned. I know he does too, because when I was in 2008, like being in the Marine Corps, getting a paycheck every 2 weeks, you don't know what a recession is when you're in the military, because you're getting paid. You know, even if your family's struggling, you still don't see it, because you're getting paid. But he wasn't in yet, so he got to see it, a lot of it in the street, and seeing people lose their jobs and seeing everything that was going on. But being in the military in 2008, 2009, 2010, like, I'm buying a house during that time. You know, I got $8,000 from this special thing that first-time home buyers that Barack Obama put out there, and I'm over here making money, and I'm like, you know, like I'm going to buy business as usual, and I'm feeling protected. So like, that's the big reason I put this out there. So we got 10 minutes left. Jesus, you got any questions?
I don't think so, sir. I'm still trying to process everything. I think the biggest, the one I would have question on is the tax loss harvesting. You said you're able to carry it over to other years. Is it a certain amount of years that you can carry it over to, or is it just the following year?
No, as of right now, as of the latest tax laws, you can just keep carrying it over. Just the maximum you can do is $3,000 a year. But you know, things are subject to change, especially with the way the government is going to have to pay back all this debt for everything that they're pushing back. Like, I think a lot of the tax laws are going to go in a totally different direction, where we're going to suffer because we're going to have to pay back a lot of this stimulus that was paid to us. So as of right now, that's what it is, Jesus. But yeah, man, I just wanted to keep it simple today. I thought this was a very important subject, especially for the younger ones that we have. Uh, they haven't experienced something major, you know, so I felt this would be a very important thing to happen, because, you know, starting Monday, it could be one of these either corrections or, you know, a crash. We're due for one. Like, we're super due for one. We're about 20 years, 15 years overdue for a correction. So anything else? You got anything, Matthew? Anything else? Nah. Jesus, you good?
Do you think that this new, I guess, or that a new like split stock trend is gonna pick up within the FANG stocks? Do you think that's gonna, you know, be an indicator for a continuing bull market?
Again, man, I think even the whole stock market doesn't have to crash as a whole. I think, my personal opinion, Facebook is still undervalued, and they should do a stock split. I think Alphabet, Google is undervalued, and they should do a stock split because of how many shares they have outstanding right now, which is not much. Even Tesla, man, like, looking at Tesla, right now they're about to have the same amount of shares outstanding as Amazon does. Amazon only has 500 million, and Tesla is about to have a little bit over 500 million shares outstanding. So even they don't have, but then you look at Apple, and they have like billions. We looked at that last week. Like, they're going to have over 12 billion shares outstanding. So the whole market doesn't have to crash. And that's my thesis of what'll happen, is that there'll just be a rotation. So eventually people will rotate out of the FANG stocks, and they'll you know, and the reason I feel like that is that there's nowhere else to put your money to make money right now. Like, interest rates are at an all-time low. The housing market is crashing before our eyes. I know he's shaking his head no because he's got the gold and he's got gold and silver on his mouth.
And that, my friend, is what you call the beginning of a bubble. No diversity.
Yeah, so in the middle of a bubble. But yeah, so like you can't put your money in a savings account right now. Even a market what's it called, the money market accounts, they're not paying you enough to keep up with inflation. So a lot of people don't have the, like you said, diversity's choice to have it, put it anywhere else. Put it anywhere else. And people are looking for it. They're looking for somewhere else to put it. That's why you see the big, inflated numbers in some like precious metals, and everyone is buying houses right now, even though they can't afford it. Like they're all looking for somewhere to put their money. So that's the long question. That's the long answer to your question. But I don't think that will, like the stock split itself will cause the market to correct or crash. I think it'll keep it running for a little bit longer because of like the sentiment right now. Just like the SPACs were a thing, the stock splits can become a thing as well, and that'll just keep the market trending, So there's always a thing that people are trying to jump in on. We have like 5 minutes left, and I can't really get into it as much as I wanted to, but since we're talking about it, I personally think that these biotech stocks, they're going to become the next pot stocks, the next weed stocks, cannabis stocks, whatever you want to refer to them as. So I don't know if you know the history of these cannabis stocks between 2017 and now. Like, do you know what happened? So like you have all of them, basically ACB. Have you heard of ACB, Canopy Growth? All these companies, they were hyperinflated. Matter of fact, we got 4 minutes left. Let me share my screen. Let me pull one up. So this is just one that I'll pull up, and I'll pull up the 5-year chart on it. So as you can see in 2018, we could even go to 2017. This was $5 stock, but then it became the trend. It became like, oh, this is the new big thing. Like the America's going to legalize pot, and we're trying to get ahead of the game. So we're going to jump on before they legalize pot. So what happened was they jumped in. As you can see here, like that stock went all the way to $127, right? And then it dropped, then it went up, and now this is called a triple dip, which is very rare, but it happened. And it's 110. It was $110, and then this thing dropped all the way down. It won't even show you because they won't, like, it just reflects to the normal. But they recently did a 11-to-1 reverse stock split, which means they did it because their stock was under $1, and they had to do it in order to maintain their being able to be on the New York Stock Exchange. So if they didn't do it, they were going to get kicked off. So they did an 11-to-1 stock split, which made their stock go up to about $11. And when that happened, it bounced up. It went all the way to like $20, I believe. And then it's been gradually coming right back down. So all I'm trying to say is that this is my sentiment on what I feel is going to happen with these biotech stocks, because they're doing the same thing. Like they're being hyperinflated because they're going to be the one that's the coronavirus stock. This was not as some of the other ones are, but like this one right here, you can see in March, this thing was $18, and look how much it's already gone up, So I think these are going to be the next ones to pop. And, if these things start popping and, dropping, they might be what causes the next crash or the next correction, because that's, again, it's consumer sentiment. So what do you think is going to lead to that? Nope. All right. With that said, don't forget to like, comment, subscribe, share with your friends. Like, this is a very important information. I hope you guys like the content. We're going to keep bringing it. So if you guys have ideas for more videos, let us know. I'm thinking about switching it up the next few weeks. Maybe we were talking about how leadership is important in business as well. So maybe doing like a leadership series, which I think would be great as well. So with that said, until next time.